I'm going to cover 6 best practices for tax-efficient investing. In a taxable account, of course, because in a tax-advantaged or tax-deferred account like an IRA, taxes really don't matter. But in a taxable account, they can take a big haircut out of your portfolio returns. So just so we were all on the same page with the impact of taxes, let's take a look at this example here. We'll start with the no tax example. You make a $100,000 investment, you get a 9% annual return over 20 years, and at the end of it all, your $100,000 has grown 9% annually to $560,441. Okay, done pretty well. But now let's look at taxes, and let's assume that you were trading pretty frequently in there and realizing a lot of short-term capital gains, and your short-term capital gains rate, also known as your ordinary income rate, is 33%. Keep in mind, the ordinary income rate will vary based on your tax bracket and how much money you ultimately make. And that has been in recent years as high as 39.6%. I think right now as of recording it, it's 37%. It might go up, it might go down, but it's always, I think generally always, I hope always, it stays in the high 30s. I hope it goes lower, I hope it doesn't go any higher, but for the most recent or the most kind of intermediate term history, the last 20 years or so, it's been in the high 30s. For this example, I'm just going to assume a tax rate of 33%. Well, that 33% tax rate annually is going to take your annual return from 9% down to 6%. So this model assumes that you have to sell a portion of your portfolio to pay the taxes. And fundamentally, the net gain to yourself won't matter whether you're paying your taxes out of your income and just paying your taxes, or whether you're actually selling a portion of your portfolio to cover the portfolio taxes. So anyways, that 33% tax rate's reducing your annual return from 9% down to 6%. $100,000 compounding annually at 6% over 20 years would grow to $320,713. That is a freaking huge difference for taxes, right? Like that is $240,000 difference over a 20-year period that's being eaten away by your tax rate. So taxes make a really freaking huge difference on your portfolio. Now let's shift gears here and talk about when you incur taxes. You incur taxes when you sell a security for a gain, and that might be a short-term gain. That's going to be short-term gain will be if you've held the security for less than 1 year, and that's going to be taxed at your ordinary income rate. If you've held it for more than a year, it'll be a long-term capital gain, which is going to be less than your ordinary income rate. Might be 0%. For the very highest tax brackets right now, it would be 20% plus this 3.8% net investment income tax. So 23.8%. If you're paying that 23.8% though on long-term capital gains, keep in mind your ordinary income rate would be at the highest rate right now, which I believe is 37%. So long-term capital gains holding more than a year will get you favorable tax status. And then you're also going to pay on distributions from your portfolio. Bonds will always be taxed at ordinary income. Generally, except for muni bonds, we'll talk about that in a second. Bonds are going to be bond distributions are going to be taxed at ordinary income at the high rates. Dividends, qualified dividends will be taxed at usually 15 to 20%. That might be 0 depending on your income. It could be, or no, I don't want to say it could be higher, but dividends could also be taxed at a higher rate than 20%. So I guess let's just kind of talk about what qualified dividends are. Qualified dividends come from publicly traded U.S. companies and possibly some international companies when you've held them for more than a year. If you've held them for less than a year, they're going to be taxed at ordinary income rates. But more than a year, 15 to 20%. International stocks typically will not be treated as qualified dividends. So that only applies to U.S. stocks. And the dividends will be treated favorably. Okay, so now let's get to it, the best practices for tax efficient investing, now that we've got the background of the impact of taxes on the portfolio and when you incur taxes. Number 1, keep trading minimal. Okay, so if we go back to this, if you're trading frequently and incurring short-term gains, you're going to be taxed at your ordinary income rate. If you're incurring long-term capital gains, trading infrequently, and holding securities for more than a year, they're going to be taxed at favorable long-term rates. But not only that, you are not going to pay the tax as much. You get what I'm saying here? So let's just say that you buy something, you literally just buy a stock at the very beginning, put $100,000 into it, and then, you wait until the end to sell it, well, then you're just going to pay that long-term capital gains once on it. That's literally going to be your most efficient method. So, if we were to go, let's just go back to this right here and say that you make a $100,000 investment. You literally don't sell it, and I don't know why I typed it in because I don't have to do the math. You don't sell it until your 20 years are up, and then you sell it all in one shot, right? And that's unrealistic. If you're going to use the money for, say, retirement, maybe you're going to sell 10% of it, right, at a time or something. But you just sell it all here for not practical, but for demonstration purposes. You sell it all at one time, and you incur a capital gains rate of 15%. Well, now you're left with, after taxes, $476,374, right? So you really didn't pay much in taxes by doing that, by buying and just holding till the end. Keep trading minimal, buy and hold. That is really the most tax efficient investing strategy out there when you're in a taxable account, because that's when tax efficiency matters, right? When you're in a taxable account, as I said in the beginning, it doesn't matter if you're in a tax advantage or tax deferred account. Number 2, avoid active mutual funds. Okay, so a lot of people plunk their money into mutual funds and they look at it and they say, oh, hey, this mutual fund has gotten a 9% annual return, and I think it's going to keep getting a 9% annual return. And that is very, very, very flawed logic, by the way. That's a whole nother wormhole we could go down. Just because something is done well historically does not mean that's going to keep continuing. But your mutual fund's getting a 9% annual return. You see that in the documentation. But it's an active mutual fund, so therefore it's incurring a lot of short-term capital gains or even long-term capital gains, but it's incurring capital gains. It's actively trading. You're paying taxes on that. All right, so avoid active mutual funds. What kind of parlays with this is utilize ETFs, because ETFs are pretty cool in the fact that they can trade and they can realize, or not realize capital gains, but they can incur gains without realizing a capital gain or paying a capital gain. And that is because the underlying holdings are not bought and sold, but rather they are exchanged with market participants. It's really cool how ETFs work, and they are a huge, 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 huge advantage to investors in a taxable account. So an ETF, rather than just selling and then buying another one, it can exchange the holding for whatever else it wants to hold. So ETFs are an incredibly powerful tool when it comes to taxes. And quite frankly, I'm surprised that little loophole has not been closed up on ETFs. There's no chatter of it yet. Maybe one day in the future will be. But for the foreseeable future, ETFs have this huge advantage, particularly over mutual funds. So let's just look at an example here. I pulled up the equal weight S&P 500 strategy. And this rebalances quarterly, and there's both a mutual fund for it and there's an ETF for it. And because it's rebalancing quarterly and things are going up, it's going to sell what has gone up and then rebalance to equal weight. So it's going to sell them and buy more of the losers. So it's frequently incurring short-term capital gains here. Okay, the mutual fund for the equal weight S&P 500 VADCX has a tax cost ratio over the last 3 years of 1.73. So this is how much the annual return would be reduced by. Okay, and keep in mind the annual return would basically be the same for the mutual fund and the ETF. And these tax cost ratios are coming from Morningstar. You can find this for any ETF or mutual fund out there. So for the mutual fund, it's 1.73. So if it's returning, say, 9% annually, you would reduce that to assume or to estimate your after-tax return. You'd reduce that 9% or subtract 1.73 from that 9%. That would put you down at 7.27. Yeah, 7.27% annual return, right? Now here with the ETF, we can see it's at 0.73. So you're saving 1% on taxes, and that 1% is fucking huge, compounding annually just by simply investing in the ETF or holding the ETF over the mutual fund. And the ETF probably has lower fees. I didn't look that up. But yeah, mutual funds are not the way to go for tax efficient investing. Generally speaking, when it comes to pure market cap weighted buy and hold like the S&P 500, the mutual fund and the ETF will be about the same. But when it comes to active strategies, ETFs will always win. Number 4, tax loss harvest. So this means that basically at the end of the year, you sell what is incurred a loss, or you sell what's down and replace that with a similar holding. So you sell it and then buy a similar holding. And therefore you're going to take those losses and you're going to deduct those losses on your return that year, and you should be contributing that equal amount of losses or the equal amount that you're saving in taxes to your portfolio to maximize this and really take full advantage of the growth here. One thing I will say is that tax loss harvesting is much easier when you've got a simple portfolio. I'm a big proponent of the 3-fund portfolio. I've got quite a few videos out there where I basically show that, hey, over a long period of time, a 3-fund portfolio performs usually better than most portfolio concepts out there that hold 7, 8, 9, 10 funds. Just a simple 3-fund portfolio weighted to the proper allocation of stocks and bonds for your time horizon performs incredibly well. It also makes tax loss harvesting incredibly easy because you only have 3 funds that you need to harvest for. When you start getting into these more complex portfolios, you can have a hard time finding funds to tax loss harvest into. So finding a comparable tax loss harvesting equivalent fund, it can be hard to find that. You've just got more legwork. And 7, 8, 9 funds doesn't really sound like a lot, especially if you've never really gone into it and been an investor. But I know personally, as you get more and more into investing, simpler just feels better. I just want to, go in and harvest from 3 funds and not harvest from 7, 8, 9 of them, or a bunch of them. Tax loss harvesting, though, can add to your returns, particularly if you're taking the amount of money that you saved on taxes, the amount you would have paid in taxes, and contributing that much to your return. Next up, use municipal bonds. Okay, so government bonds, or not government bonds, but muni bonds. Government bonds could include treasuries, which from the federal government are not tax advantaged. But bond payments from municipalities, cities, states are not taxed at the federal level. So rather than holding, say, 10-year treasuries for your bonds, you want to hold muni bonds in your taxable accounts. And finally, use margin loans instead of selling. And I know this is something that many financial advisors will not talk about. And keep in mind, I am not your financial advisor, and I am not a licensed financial advisor. This is just general information out there, particularly information that applies to myself based on my own research. Before making any financial decisions, you should consult with a professional or make sure you do your own due diligence. All right, so now that we have that little disclaimer out of the way here, I like to use margin loans instead of selling. So rather than selling my holdings, if I need cash and incurring a capital gain, I like to borrow on margin. Okay, now I'm not going to use large amounts for this because there are, minimum equity requirements that you need to have in your account. But if you use a brokerage like M1 Finance, I have an account with M1 Finance, you can get margin rates at 2.25% right now. That is lower than the cost of selling it and incurring a capital gain. Okay, particularly if you're in a high tax bracket. If you're in a high tax bracket and you're going to be incurring those long-term capital gains rates at 23.8%, well, it's much, much, much cheaper to just pay your 2.25%, right? And when you need money or you need to take money out to whatever you need to take money out for, rather than selling it, borrow. Interactive Brokers also has good margin rates with their Interactive Brokers Lite right now. It's 2.83%. If you do the Interactive Brokers Pro, you can get it at 1.83% or lower if you're borrowing more than $1 million, right? Or even, I guess, more than $100,000. So yeah, I frequently use margin loans. I got a whole video on this, on how I use margin loans, particularly to fund business asset purchases, business investments, and accounts receivable from my businesses. I frequently do that. So those are my 6 best practices for tax efficient investing. If there's any best practices you feel like I missed, let me know in the comments below, guys. I'm signing off on this one. Hope you found it helpful and insightful.